Okay, I want to do a real quick video on this as well. About this whole IV rank. All right, it's really simple. When IV rank is high, you want to sell both put and call spreads because you'll get more money when IV rank is high. Now, when Karen sells call spreads, now let's get straight. She doesn't do golden geckos, okay? She does naked puts and naked calls, and she does not put them on at the same time. So when you see that, what she loves is she loves this, right? You see these blue lines? This is my Bollinger Bands, but they're set for 2 standard deviations away. What that means is, like right now, okay, the market's up. Karen would be betting, like if like IV rank right now is 30, 40, not the greatest, right? But if she's putting on positions now, she's betting that IV rank will drop lower, like down here, but she's also betting that the SPY will not go lower than, let's say, 2 standard deviation ways right here, 197. So she's betting, let's say, by the next expiration date that the SPY will not go below 2 standard deviations of where it is right now. And as far as why she does SPX over SPY, take a look. The SPY is $204.97. If I change this to the SPX, it's 10 times more. Okay, watch. Look here it is. Okay, 10 times more. So the reason why she trades SPX is, yes, there's 2 reasons why. One is it's larger, which means for every 1 contract she could trade on the SPY, she could trade, for every 1 contract she trades on the SPX, it's equal to 10 contracts played on the SPY. So let's say 1 contract in SPX is about $2,000, right? So let's say every time you make a trade, you're willing to go in and you don't mind risking $2,000 anyway, right? Why pay 10 commissions on 10 contracts in SPY when you can do 1 only on the SPX? So if your account can hold, if you have an account that can handle SPX, then do it. The other reason why she does SPX is she handles other people's money, which means also, even for yourself, there's different tax consequences when you trade the SPX. Part of your winnings gets taxed as capital gains, which is a lower tax bracket, and the other part gets taxed at ordinary income. So if you're trading this large, and we're talking the way Karen does in the millions and millions of dollars per transaction, right, for her clients as well, they're better off doing it this way because their gains, at least part of the gains, are taxed at the lower tax bracket, which is capital gains tax. All right, so, but if you listen to Karen's video, if she was trading for just herself, she'd probably be doing just SPY as well, especially when she was just starting out. But, if your account can handle SPX, then do it. Trade SPX. All right. For those of you, and she does them naked, meaning she's not doing golden geckos. If you don't have to do golden geckos either. I just did golden geckos because 1, you can do them in an IRA account, and 2, you can do them with a small $3,000, $5,000 account. All right. If you have larger amounts of money, don't do it. Go naked, or at least it's up to you. It's a way of just preserving capital. All right. So as you can see, she loves this. When IV rank, when the market's going down like this, look what's happening to IV rank. It's going high, right? So what is she doing? She's selling puts all the way down. Why? Okay. She's betting that the market will stay above. When she sells a put, that's 2 standard deviations away. So at this point in time, she's betting it won't go lower than 2 standard deviations below whatever is trading at that time. She's also betting that it'll stop at some point and the market will rise like it did here, and IV rank will drop and she'll make money. So of course, let's say you're trading right around here. She's probably trading for an expiration date around here, or I don't know, I guess you could over here, but it's not a whole lot of days, right? So anyway, and look, if you do it, the market, look what happened to the market. It came right back to where it was on this day, right? So if you're selling golden geckos, what? You made money left and right, right? Because you were selling golden geckos, it didn't break, it recovered, right? Same thing, it didn't go high, it's perfect. It's staying within, it's been staying within a 2 standard deviation range. I think even a 1 standard deviation raise, if I can recall. So that's the beauty of the golden gecko. It's not the best thing since sliced bread, but you have a 6 to 8% chance of being right. How do I know that? Well, for you new people, look, do a SPY, do a strategy, do a strangle, okay? And I'll do 1 standard deviation. Here it is. So, man, Doe is down right now, but I can do it manually. Here, watch. I'll change this expiration to this, and see how there's no lines right now? I guess because Doe is down. You don't need them. Look. See this toggle? Toggle to shows the percentage. Drag the call side to it says 84%. Okay, so see this? Drag this to it says 84%. Oh, sorry. Close to 80, whatever, 85. Let's go 85. Let's drag this to 85 too. And I don't know if it'll work because I think Doe is down or something. It should show you a calculation. It's not showing. But this will be 1 standard deviation array. But when you have 84% probability to be on one side and you have 84% probability to correct on the other side, that basically equals to a 68% chance of being right. Okay, so I guess I'll do this video again when it's working. But basically, let me show you what Karen is doing. Then I'll just close off this and I'll try maybe switch it to SPX or whatever is what she's doing. Okay, so whoops. Let's just do, what am I doing? I'll just do a short put. There we go. 56 days expiration. 80, yeah, that's perfect. All right. So this is what Karen does. She's trading as close to 56 days expiration as she can. And if the market is going down, she'd sell puts. So, and I don't know what's going on with this because I can't zoom out. Anyway. Oh, what's going on with Doe? So there we go. And the stock, I'm already zoomed out. What is this doing here? Wow, why is this all the way like this? Can I scroll it? Here we go. All right. So when the stock market is going down, she tries to, now on the put side, she does it to 95, 98%. Hold on. It's not changing. 99. Here we go. Here. She's trading around this area. Okay. So she'll sell a naked put that expires in 50. She'll start trading around now. See, so she has a 95% chance of being right, which is close to a 1.5 to 2 standard deviations out of the money. So she's betting that in 54 days, the SP 500 will stay above 1825. Look where it is now. Look on your chart. Where's 1825? 1825 is down, right down here. So she's betting it won't crash below here within the next 55 days. That's it. All right. Now, if the position starts moving against her, here's how she rolls. All right. So let's say she puts this position on, and then the stock market starts to drop. Right. She doesn't do anything. All right. When does she roll? So since I can't control the market, what I'll do is I'll make pretend. Right, the market's dropping, so it's getting closer to this strike. When she sees this, she'll roll. But in her case, she rolls not to the following month. She keeps it in the same. She wants it for it to expire in the same month. Because why? Because she's managing money for someone else. She likes to close out her month at month end. So what she'll do is, okay, so let's say she loses, I don't know, whatever. Let's say I'm just going to keep math the same. Let's say if rolling is just closing and moving to another time. So you're taking a loss. So let's say she loses $1,000, right? And then so she rolls, and I'll change the expiration date up here. So let's say she rolls to the end of March, which is a weekly. Let's say like this quarterly one. She'll roll, and then she'll move this back out to like 84%. All right? And then let's say she lost 1,000, right? And let's say she can't collect enough to cover 1,000, the 1,000 she lost. Instead of one contract, she'll put on 2 to collect the money that she lost in her roll. And even if that's not, then if you listen to her, even if that's not enough, she goes, okay, well, wait, why don't I also collect some money on the call side so I can make up any money that I lost, in that previous trade by end of March. So she'll go grab a call, and she'll move the call out to the same quarterly. If I scroll this down, I don't know if I can scroll down somehow. It won't let me. Yeah, something like that. Actually, I'll double click it and I'll move it to the same March 31st. See, so this, I'm going to change this to March 30. Okay, right. So she'll sell a call, okay? And she'll sell a call maybe another like 84%, which is 1 standard deviation away, because she can collect more money to make up for any money that she lost. That's what she means by when she makes money, she's not giving it back or she's not collecting back. She'll basically, it's almost like doubling down, but she's putting on more positions and putting on more positions to collect any money she lost when she rolls. So now look what happens at the end of March when it does finish in between this range. It's a full winner. She gets all the money, and in the meantime, every 55 days to expiration she's putting on a new position. It works the same when you're doing a golden gecko. I'm not saying that the golden gecko is like the best thing since sliced bread. All I'm saying is if you do a golden gecko like this and you're doing it, at least, let's say if she does 56 days expiration, let's do this, okay? 1 standard deviation away, 5 strikes wide. With Tasty Trade's market measures, and I'm going to expand this so you can expand the width like this. I'm going to move them out. And I'm going to move them out. See, I'm going to expand the width until these get close to 84%. Because I think Doe is down right now doing, so I don't know what's going on. 84%, all right? And see this? I'll just move this. Move this to 84%. If I can, it won't let me. Oh, right, and we're doing it on the, you can do it on SPX too, doesn't matter, but I don't know if I can. I don't know, there we go, it's not letting me. Anyway, this is as close as I'm going to get. And then I want the strikes between here and here to be $5 wide. Okay, so I'm going to move this, and see how it's 0 up there. I want to move this to it says 5, and it won't let me because I don't know what's going on. I guess I can't do it right now because of Doe is freaking off today. So it's Saturday, that's why. So, or it could be my computer. I don't know. But basically, when you do a golden gecko, that's all you're doing. Now, when one side gets tested, you can do the exact same thing, right? You can roll it. Well, in your case, since you're not managing someone else's money, you have time on your side, so you can roll it to the following month and keep the same strike price. And what you're betting is the market will come back. Okay. Wow, what's going on? You're betting the market will come back, and you move back into a winning position. Well, what do I mean by that? Look. Okay. So I'm gonna go like this. Oh, I'll even go like this. Follow along. This is last year, right? March 29 and let's say your put side gets tested. So you keep the same. See, let's say you did it right around here. Your right arrow was right here, and you started selling a put. Put a golden gecko on, and you bet it wouldn't go below whatever here, right? And then it did go below there, and like, oh my god, right? So you roll it to expire, not this, but the following expiration, right? And look what happened. It came right back. So you would have been fine on the put side. But then all of a sudden your call side got tested over here, right? Because you're glad it came back to here, but now it went above here. It got higher. So now your call side is getting tested. So crap, now you got to roll your call side. So you roll your call side out to, the following expiration, which is not this one. Okay, let's say it's December, right? And look what happened in December. Remember we were here, right? And it came in. So same thing over here. Okay, let's do it this way. IV rank is above 50, so you would have put on new positions over here, right? Right at 50. Okay, so you're going to sell a put and a call, golden gecko, right? And then look what happens. I'll scroll a little bit. Oh, you're getting tested. Oh, your put side is getting tested, let's say, right? But you still got time. You got a lot of time left. Because when you're selling this one, you're selling January expiration, not you're selling 45 days out, right? So you stay there. You stay in the position. Look what happened. It came back. So any golden geckos you put on in December are full winners. That's the beauty of the golden gecko. I hope that helps. Have any more questions? Let me know.